I'm Michael at Gym Financial Officer. With my unique experience as a small business owner, gym owner, and a software engineer at the IRS, building out many of their internal systems, including the IRS tax audit system, I enjoy helping small business owners optimize their finances, most commonly through profit growth and through tax saving strategies. But today I wanted to focus on two simple tax saving strategies, specifically tax status of your business, S Corp, LLC, C Corp, whatever it may be, as well as a rule commonly called the Augusta Rule. A really well known strategy, but many times small business owners overlook this and it could save tens of thousands of dollars in taxes. So let's dive in and see how this is done. As you can see, we're going to be stepping through a lot of the information on the screen, but at the very beginning, I want to point out this number right down here. This is a good example, this scenario that we're going to walk through, of what a lot of small business owners see in their finances. And the truth is, this is the kind of savings they can see if they're not implementing these two strategies. This isn't meant to be any sort of clickbait. This is just a really common thing that when I talk to friends and other small business owners, they're set up very incorrectly and they can be costing themselves tens of thousands of dollars in taxes that they owe. So, like I said, there's something called the Augusta Rule over here. That's what it's known colloquially. It is really just the ability, it got its name from the Golf Masters tournament in Augusta, Georgia, where individuals that owned homes near the golf course would want to rent out their home, but then they didn't want to have to pay taxes on it. So the IRS has a rule where if you rent out your home for 14 days or less per year, again, 14 days or less per year, you don't have to pay any taxes on that income. For most people, this doesn't really mean much, but as a business owner, you can start to think of some ways that this could be utilized. The most common way that is consulted on, I'm sure I'm not the first and the only one to teach about this, is to rent your home out to your business for a conference, for a meeting, for an event, whatever it may be. Now, the reason that this matters is because if we rent out our home for a single night on Airbnb or something, let's say you can get maybe $300-$400 a day or a night for that income. You do it 14 times, well, up to 14 days or 14 nights, you can only get 14 times 400. So the question is, how do you get more than just $400 a day or a night to rent out your home? And then what is the upper limit? The simple way of doing this, I'm not going to show it in this video, but a simple way is to do research on your area for conference rooms or meeting rooms, usually at hotels or conference centers, to see how much you could charge per night. Now, I've looked in my area and other areas around, and it seems the most typical cities like Phoenix, Charlotte, Dallas, Nashville, you can charge probably $1,200 a day to rent a conference room at a typical venue. This would include, seating for 8 people, internet, TV, presentation materials, food can be provided, things like this. Now, I'm giving all these details, and again, if you want more information on this, you can meet with me at Jim Financial Officer. Get your free business tax review. The link will be provided in the description. The point is, I just want to give you a high-level overview that this is in the IRS tax code, and the objective is your business will be renting a place to hold a conference, a training, a presentation, something of that matter. It so happens that your business is holding that event at your house, right? There's the entity of your company, and then there's the individual of you. The IRS, again, has given a provision where your business obviously can expense this because it's an expense that it's holding a conference, it's holding an event, and it's paying for a venue. It's an expense. But the revenue then, that money is actually coming directly to you. So you're able to reduce your taxable income at your business, your profit, and increase money coming into your personal bank account without it being taxed. again, this is legal. We could get into the details how it's handled, but that's one of the easy tricks that you can do here to save a lot on taxes. And we'll get into the numbers on the right in a second. The other method is an S Corp status. Again, a lot of small businesses are set up here, and a lot of this depends on your revenue, because if you're bringing in $10,000 a year in revenue or earnings, S Corp isn't going to do anything for you. In fact, it might be a burden because you can't pay yourself the salary, and there's going to be some debate there as far as with the IRS as far as what you're doing. But in the event, for this example that we're going to run through, is the idea that you have $150,000 of earnings, of profit, right? So maybe you're a $400,000 revenue gym or fitness center, and you have all your costs, etc. And at the end of the day, you have $150,000 in profit, sometimes referred to as seller discretionary earnings. Now we're going to take this number, and now we can move over to the right-hand side of the screen. We see in the first example over here of an LLC, this is where we're just set up as a strict pass-through. Maybe we're filing on our 1040 Schedule C, right? I'm just the sole owner of this business. I don't split it at all. Maybe we're filing on a 1065 or a a partnership, but it's common that maybe it's us and our spouse or whatever it may be. My point here is that we're not set up as an S Corp. And again, this is just your tax filing status. This is not your legal entity. We'll keep that separate for now, because if you don't know, an LLC, the legal entity, can be taxed as a strict pass through, as an S Corp, as a C Corp. It has multiple options. So we're not talking about your legal entity structure, filing with the state that you're an LLC, an S Corp, a C Corp. We're purely talking about your tax filing status in this video. So let's return here. In this example, this first example, we're set up as strictly a pass-through. We're not utilizing the Augusta Rule, and we're not utilizing S Corp status. As we go to the second column, we see this column over here. We're now utilizing this meaning expense. This is the Augusta Rule. We're tapping the Augusta Rule. So what that does is we notice the earned income goes down by the amount of the Augusta Rule. Again, what does that mean? At the end of the day, we brought in a certain amount of revenue, we had expenses, and we had $150,000 in earnings. The Augusta Rule, we're sending that money to ourselves. So technically, it's still the same amount of earnings as far as we're concerned, right? But as far as taxes is concerned, it does reduce our taxable income, right? We went from 150,000 down to 135,000. And we see how that then trickles down through federal taxes, through FICA, etc., down to a $6,000 tax savings. That's very beneficial just for the Augusta Rule, right? Now let's look at S Corp. Over here, we're going to look at an S Corp. So really, we're kind of comparing these two columns, an LLC versus an S Corp, but without the Augusta Rule. We notice, if you're unfamiliar with how an S Corp works, the main advantage is that instead of paying FICA taxes, considering it as earned income on the entirety of our income that's passed through, an S Corp is a small business corporation in the IRS tax code, and it allows us to take a fair and reasonable salary, which again, we could talk about that specific to each business, but I'm going to list $60,000 because I believe that would be fair in an example like this. If we have a $400,000 revenue fitness center or gym, it's really common to have a $60,000 salary business manager, whatever title you want to give it. So in this example, there is $60,000 salary, and that salary is responsible for FICA taxes because it is earned income. Now I put the $9,000 amount because FICA taxes, if you're unfamiliar, it's normally, we only think of if you're an employee that receives a W-2, you only see half that FICA tax represented. But in reality, it depends on, maybe your employer shows you, but the full FICA tax is 15.3%. This is Social Security and Medicare, Medicaid. The IRS, the government, it has determined that it is split between you as an employee and your employer. So in this situation, we are the employee, but we're also the business owner, the employer. So it actually costs us $9,000, right, in total cost. Some of that is withheld from this amount, right? 60,000. Well, really half of it. Half of it is withheld, so about $4,500 is withheld from the 60,000. But the other 4,500 is technically a cost on top of this, right? So we're actually, so what I've done here, that's why now we step down here to passive income. We notice that if we're earning $150,000, 60,000 should have 90,000 to equate to the 150,000 total. But the passive income is reduced by the half of the FICA taxes paid by the business. Again, half of it is paid by the employee from the 60,000, so we can't reduce that as an expense to the business. It's really, an expense to the employee, so to speak. But the other half, the business's side of the FICA taxes, are an expense and they're deductible to the business. So you see, we've already reduced our taxable income in the passive category by that amount, $4,500. As well, I want to point out here again, we're talking about salary. So this is the earned income. And then we're splitting out the remainder. Again, $150,000 of earnings, 60,000 we take as a salary. The other 90,000 would technically come through as passive income because that's the beauty of an S Corp. Could get into the details in another video. I'm just trying to lay it out here and trying to explain the math of that's where that money went, half the FICA, etc. I'm not going to get super detailed here. Maybe I've already gotten too detailed. Point is, we now can step through. We look at the federal taxes on the earned income, right? The earned income here. It is, if we add up passive income and earned income federal taxes, we'll notice that it's less than $19,000. But in the LLC scenarios, we paid $22,000 and $25,000 respectively in the two scenarios, whether it was Augusta Rule or not. Already, even without utilizing the Augusta Rule, the S Corp, we paid less in federal income taxes. Same with state income taxes. We'll notice, well, at least for the non-Augusta Rule scenario, we're paying less in state income taxes on the S Corp. Now, before I explain everything, let's just finally jump and look at the very final example. This is the example where we're utilizing everything. Well, both the easy tricks, right? We're utilizing the Augusta Rule. We see it here, $14,000. And we're also utilizing S Corp status. So what's that do for us? We notice, again, you could step through the numbers and see because of the $14,000, it reduces our passive income by a certain amount, by an additional $14,400 compared to here. We then step down. FICA taxes are the same because the FICA taxes are based off of the 60,000 number. But, and so yeah, federal, again, earned income does not change. That's why these two values don't change. But what really matters is going to be down here. Here we go. These federal taxes, state income taxes on the passive income, we notice that those have reduced compared to here in the S Corp category. And now our total taxes, let's really look at that right here, right? $30,000 is our total taxes on this. Let's clean some of this up. $30,000. Where did we start? $54,000 is what we're paying if we don't utilize these two tricks. Well, I shouldn't call them tricks. These two methods on $150,000 of earnings. $24,000 is our tax savings. Again, this is pretty absurd. It seems absurd, but this is a really common scenario. So I just wanted to point this out, run through the numbers. Again, at Jim Financial Officer, we help people with this. We can set it up. We can review. Again, I mentioned that we're not referring to the entity status, LLC, S Corp, C Corp, referring to the tax status. If you have any questions about these things, I would love to meet with you. Please reach out for your free business tax review. It's going to be in the link in the description again. Otherwise, look forward to chatting with you soon.